Is your agency actually sellable? 6 financial numbers buyers will check first. Do not wait until you want to sell your agency to find out your agency is not sellable, because by the time a buyer starts asking for your numbers, it may already be too late to fix the story. Hi, I'm Cody. I'm a CPA, and we work with marketing and PR agency owners who want better cash flow, stronger profitability, and proactive tax planning. Today, we're talking about exit readiness. Not because every agency owner wants to sell tomorrow, but because the same numbers that make an agency attractive to a buyer are usually the same numbers that make it healthier, more profitable, and easier to run today. The recent Publicis deal to buy LiveRamp for $2.2 billion is a reminder that M&A is still very real in the marketing world. Publicis said the acquisition would help deepen its AI marketing and data capabilities. Now, most agencies watching this are not Publicis. You may have 5, 10, 20, 30, or 50 employees. You may be doing between 1 million of AGI to 10 million in AGI. But buyers still care about the same basic question. Is this agency financially strong, transferable, and worth the risk? So today, I'm going to give you the agency exit readiness scorecard. 6 numbers buyers actually care about. Number 1 is EBITDA. For those that don't know, EBITDA is earnings before interest, taxes, depreciation, and amortization. And let's not get stuck on the technical term here, but here's the practical question relating to this. How much real profit does your agency generate before certain accounting and tax items? That's really what EBITDA is. A buyer is not impressed just because your agency is busy. They are not buying your late nights. They are not buying your proposal activity. They are not buying your gross billings. They are buying a profit engine. And this is exactly where agency owners get themselves into trouble. They said, we did 5 million last year. Okay, but how much of that was agency gross income? How much was passed through? How much went to outside contractors? How much actually hit the bottom line? If you can't answer that clearly, you do not have a buyer-ready financial story. The solution to that is monthly financials. Not once-a-year books, not tax time cleanup. Monthly financials that show profitability, margins, direct costs, overhead, and cash flow. If your numbers only get cleaned up after the buyer asks for them, you're already behind the 8 ball. Number 2 is client concentration. This is one of the first risk factors a buyer is going to look at. What percent of your agency gross income comes from your largest client? If one client represents over 35% of your agency gross income, that is a major risk to the buyer and the seller. Even if that client loves you, even if they've been a client for years, even when they say they're not going anywhere, a buyer is going to ask, what happens if that client leaves? What happens if the owner is the relationship? What happens if that revenue does not transfer? This matters a lot for marketing and PR agencies because many client relationships are personal. The owner sold the account. The owner still leads the strategy. The owner is handling the difficult conversations, and that works or may work while you own the agency, but it weakens the value of the business if the buyer believes the client may leave when you do. So here's what I would track. Your top 5 clients as a percentage of agency gross income, not revenue, agency gross income. And then I want you to ask, are those relationships spread across the team? Are there signed agreements? Are there clear scopes? Is the client profitable? If the answer to any of those is no, that's not just an exit problem, that's a management problem. Number 3 is recurring agency gross income. This is one of the biggest value drivers in an agency. Buyers like predictability. They want to know what revenue is likely to repeat. For agencies, that could be monthly PR retainers, paid media management fees, SEO retainers, content programs, analytics, strategy retainers, or ongoing creative support. Project work is not bad, but if every month starts at 0, the business is harder to value. And here's the mistake. An agency owner says, we have 4 million in revenue, but a big piece of that is media spend, production, software, printing, or other pass-through expenses. That is not the number you use to pay your people, cover your overhead, or create profit. You need to know what you actually keep. Agency gross income is the number left after direct client costs and pass-through expenses. In my agency materials, AGI is described as the amount left after paying media vendors and other direct costs, and it is the money available to pay the agency's operating expenses and salaries. So let's break your AGI into categories: recurring AGI and product AGI. One-time AGI, Pass-through. If you want to improve your exit readiness, increase the percentage of AGI that is recurring and predictable. And that's actually going to make the agency easier to manage and easier for a buyer to understand. Let me ask you a question. If a buyer looked at your agency today, which number would make you the most nervous? Profit, client concentration, recurring agency gross income, utilization, your gross margin, or owner dependency? Drop it in the comments. I look at them all. That answer will probably tell you where your next financial cleanup project should start. Number 4 is utilization. This is where a lot of agencies lose profit without realizing it. You can have a great team, you can have strong clients, you can have a packed project management system, and you can still have poor utilization. Utilization tells you how much of your team's time is actually producing client value. Not internal meetings, not rework, not scope creep, not quick favors that never get billed. Actual client delivery. And for agencies between 10 and 50 employees, this is a critical number to know because payroll is usually one of your biggest costs. If your team is underutilized, profit is disappearing. If your team is overutilized, quality will drop, people will burn out, and clients will feel it. And if you're not tracking your utilization by role, you're guessing. You should know your utilization for account service, for creative, for strategy, PR, content, media, development, and operations. But don't stop there. Compare utilization to client profitability because some clients keep your team busy, but may still produce weak margins. And those clients need to be repriced, rescoped, or managed differently. Busy is not the same as profitable, and buyers know that. Number 5 is gross margin. This is where agency accounting has to be done correctly. A generalist CPA may look at your agency like any other service business, but agencies have their own math. I call it agency math. You have gross billings, which is a bit of a vanity metric. You have your pass-through expenses. You have your direct client costs. You have your contractors. You have your delivery labor. And then you have the number that actually matters, agency gross income. If your financials aren't separating those pieces correctly, your margins may be misleading. And misleading margins create bad decisions. You may think a client is profitable because they generate a lot of revenue, but once you remove your media, your production, your freelancers, delivery time, you may be making no money on that client. A buyer will probably want to see margin by client, by service line, and by revenue type because they want to know which services are profitable, which clients are profitable, and which clients are draining the team. What offers should be scaled, and which ones may need to be fixed or maybe even eliminated. And you can't answer those questions from a messy profit and loss. You need a chart of accounts that's built for an agency. You need clean, regular monthly reporting. And you need somebody that's reviewing the numbers with you before there's a problem. Number 6 is owner dependency. This one might be the most uncomfortable of them all because most agency owners are still too involved in too many parts of the business. You close the deals, you manage the largest clients, you're reviewing the strategy, you're solving the team issues, you're approving the pricing, you know where everything is. That may make you valuable, but it likely makes the agency less valuable. Because a buyer is not just asking how profitable is the agency with the owner, they're definitely asking what happens when the owner steps back. If the answer is everything gets harder, then the agency has a transferability problem. So measure owner dependency. What percentage of new business comes directly from you, the owner? How many key client relationships are owner-led? How many decisions require your approval? Can your leadership team run the agency for 30 days without you? If the answer is no, you have work to do. So start moving client relationships deeper into the team. Document your sales process, build leadership, create pricing standards, get your delivery process out of your head and into the business. A buyer wants to buy a company, not a job with a logo. So let's look at the 6 key takeaways. And here is the agency exit readiness scorecard. Number 1, EBITDA. Does your agency produce real profit? Number 2, client concentration. Are you too dependent on 1 or 2 clients? Number 3, recurring agency gross income. How much of your AGI, agency gross income, is predictable? Number 4, utilization. Is your team's time turning into profitable client work? Number 5 is gross margin. Do you know what the agency actually keeps? Number 6, owner dependency. Can the agency run without everything going through you? These are not just exit numbers, these are operating numbers. If you improve them, you build a stronger agency. You improve cash flow, you'll make better hiring decisions, you'll price smarter, you'll reduce risk, and if a buyer ever does come knocking, you are not scrambling to explain messy books. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.